Madam.
Okay, Assalamualaikum. And very good day to all my students out there. Okay, let's look at this question. We're going to be very quick today, which is a question that I have picked up here is question February 2023. It was from the final exam. So let's look at question 2A. Question 2A is where it is the question only asks you to lease. So when you are asked to lease, you don't have to go that detail. You just need to go and jot down or write down whatever the answer. Where is my mouse? Okay, just list what the example of contract based intangible asset. Some of the examples are like a franchise. Yeah, so let's just look at our answer here. Okay, you can these are the one that normally arise through contract based license, maybe license that was granted by government to us to operate a radio station, perhaps franchise agreement between you and the franchisor. The rights to broadcast, let's say to broadcast the rights to broadcast the English Premier League, those are actually contract based intangible asset, right? So you just need to mention any two of that. So maybe you may write something else which are also relevant. The answer is acceptable. So let's look at the second question. You have Fast Rapid Transit Corporation. FRT is a company that involved in developing high-speed railway. High-speed railway and okay. You are informed that the company involved in that railway net, the rail network will bridge the east coast and the west coast of Peninsular Malaysia, right? And then you have this information which I have already highlighted in different highlighter, where you would see the one in yellow is related to the one particular sort of intangible asset, and another one in blue is to another types of intangible asset. So let us look at what we have in the first sentence. 1st January 2020, the company entered entered into a contract to acquire. Okay, you have the word there, entered into a contract. So when you entered into a contract, you entered into a contract, meaning to say that this arise through a kind of agreement. So that means that what was in the contract, it was about a contract to acquire a software. So the software is 12 million. This is what you have here. And it has an estimated contract period or useful life, you can call it 6 years. So 12 million here is the initial cost. So you can just highlight that. This is the initial cost. Okay. Next, then you are informed regarding the fair value. But before that, this 12 million is on the initial recognition date. The initial recognition date is 1st of January here. And you have one information here at the end of the year. You have fair value. The one in green is fair value as at 31st of December 2020. And that was 15 million. And another fair value is given on 31st of December 2021, which is 6.5 million. And if you look at the bottom of the question, at the bottom here, in number 1, you are informed the company accounting policy is to adopt revaluation model on its subsequent measurement of intangible assets. So meaning that the software earlier has two fair values. So you need to go and account for the changes in fair value as either revaluation gain or revaluation loss, revaluation surplus or deficit. So you need to do that. There were two revaluation there. First revaluation and second revaluation. The accounting treatment will be similar to MFRS 116. So meaning that you are going to find out what is the carrying amount on the first date as well as the carrying amount on the second date, and then compare with the respective fair value. And what is also important here is to find out how much is the amortization and how much later that will have to be eliminated, right? So if that was the information, so that is for you to do it here, where you are asked to discuss the accounting treatment for the contract, and that was for you to discuss. So discuss means you need to write the accounting treatment. So I have provided a lot of sample in my self-study examples, and also in our previous question we did that as well, but this one is for 2 years, so you need to do that. And for the second part, you are asked to discuss the accounting treatment for another asset that was there, another intangible asset, the license, but that was for the following year, 31st December 2022. So everything is about you to write up. So these 13 marks are all about writing up accounting treatment. So that's why I want you to practice writing. So if you look at the this part here, now we move on to the next one, which is the license. So it was on 1st of January. So this is the initial recognition date of license. You were awarded a license by whom? Maybe by the government, to be the one of the main contractor in the project development. So you got the license. So if you are awarded with a license by another third party, that is considered as also a separate acquisition. So meaning that intangible asset that arise through separate acquisition or externally generated intangible assets. Both are the same, externally generated, meaning that arise through acquisition, and here it arises through license, which is a contract base. But this is what you call externally generated. And that was the case. This license required the company to develop and maintain the rail network, and at the same time, it permits the company to collect ticketing fees. Just imagine you are having the another company that has another ECR rail network, and they are trying to collect more um, let's say fares from you. Imagine like just like ART, LRT, MRT, and that was the case there. That is just an information about the future economic benefits of having the license. On that date, the license was valued to be 13 million. So the for the license, it was at the initial cost is at the fair value. It was at the fair value 13 million, and there is no foreseeable limit to the period in which license is expected to generate the net cash inflow. So when it says there no foreseeable limit, that means that it has an indefinite useful life. So meaning that this is indefinite useful life. So when it is indefinite useful life, there is no amortization for the license. So you will get, meaning that no amortization. So amortization none. All right. Okay. However, on as after a year, you were informed that another company was also awarded license. Another company, your rival maybe, was awarded a similar license. Before this, it was you monopolized it, but now another company. And because there was another company that was awarded with license, now the operating period of the license given to you that was previously having no foreseeable limit, now it was limited to 15 years. So meaning that there is a change from finite useful life. So there was a change of indefinite useful life, change to become finite useful life. So there is a change in accounting estimate here. And on that date, the fair value of the license on 31st of December was 8 million. Fair value of the license. And you are informed cost to dispose the license was 55. Cost to dispose here is referring to actually fair value less cost to sell. So the third paragraph here is actually telling you some information regarding impairment of the license, where under MFRS 138, if you adopt cost model or you adopt revaluation model, you can still have your asset be tested for impairment. So this company, it has the fair value less cost to sell of 55 million on the date here, and the present value of the future cash flow expected to be derived from the license. So this is actually value in use. So what your duty now is for you to take note that this is not revaluation, this is impairment. So for impairment, you normally will find out what is the carrying amount, and you will go and compare with the recoverable amount. So recoverable amount, you may have to go and find out what is the fair value less cost to sell. So you have here fair value less cost to sell. But what you need to find out is what is the higher between. This is also from similar to MFRS 116 application for impairment of MFRS 136. So between what? Between fair value less cost to sell and value in use. So you need to do that as well. So that is what happened for the third paragraph, which is on license. License, you will have to calculate impairment and explain what happened during that period, right, for 2022. And then for earlier on software, you need to go and explain on the revaluation for those 2 years. Both asset will be amortized, so there is no depreciation. Amortization is monthly basis, so you have to take the month ownership. And the company also has some policy of transferring some revaluation surplus back to retained earnings. So these are actually the situation where you are showing that some of the surplus has been realized. So this is also similar to MFRS 116, where here you are going to go and debit how much is the ARR, and you are going to go and credit your retained earning, because you need to transfer the surplus to the retained earnings account annually. Okay, what do you need to do for for the software software all right, software, you need to go and discuss what happened on 31st of December 2020 and 31st December 2021. You need to discuss initial recognition, initial measurement on 1st of January 2020. So you need to discuss initial recognition, initial measurement, subsequent measurement for 2 years, 31st of December 2020 and 31st of December 2021, explaining the revaluation, just like what you have in the sample self-study that I gave you, right? Something like that. So that was for the first one. The second one, you need to discuss the accounting treatment of the license, starting from first of initial recognition, initial measurement, and subsequent measurement here only on 31st of December 2022. But here, initial recognition, initial measurement on 1st of January 22, 1st of January 22. So you should know what you have to discuss. And I have already given a lot of example there. So let's look at what we do. Before we can discuss, we may have to do some workings. So we have to do some workings to get the marks for the working. So I will start off with software. So let's just go to erase this all. Okay. So you can do that yourself actually, because this is very similar to MFRS 116. So I start off with the software. My screen is having problem. Yeah. Wait. Okay. You have to discuss for 2020. So before you discuss, just to show you, 1st of January 2020. When is the date? The date of initial recognition. This is where you have the cost of the software. So go and find out how much is the information there so that you can calculate the amortization. So 12 million. And first year, you will have your amortization. How do you calculate amortization, class? You take 12 million and that will be divided by 6 years. So you are given the information there. So you will have 2 million. So now you will have carrying value of 10 million. So this is your carrying value, carrying amount. This is on 1st of January 2020 now, 2021. And that was actually 31st of December 2020. Okay. So I put here 1st of January 21. So in the second year, in the second year, you have, in the first year, is this the first year? Yes. First year, you have one revaluation. So I put here 31st of December 20. Revaluation here. So you will compare that fair value with the carrying value. The fair value was 15. Look at where I am showing you. Look at the part that I show you. Okay, this one. And you will have 15. So that 15 million, you can see that there will be 3 million different. That 3 million different is your revaluation surplus. And remember, this is initial what? Class? Initial? No one is in the class.
Revaluation.
Initial revaluation. Okay, so you have the revaluation surplus, first revaluation, which is 5 million. You need to understand that this will be debited to the software and will be credited to the asset revaluation reserve. You should know that. You learned this many, many times. Now we go to the second year. This one is first year. So the second year is 1st of January 21. Remember, second year you have another revaluation. So on this date, your carrying amount or carrying value of the asset will be at the revalued amount. The revalued amount here is the fair value. So this fair value here will be here. And that would be 15 million. Your evaluation does not take place at the beginning of the year. It took place 31st December 2021. So by 31st of December 2021, you may have to provide the amortization first. And the amortization here will be based on the revalued amount. Revalued amount. So you get the amortization would be 15 million divided by the remaining useful life. Remaining useful life here now will be 5 years. Why 5 years? Because you have already used the software for 1 year. So now remaining, so here it is still 5 million. So this 5 million is your amortization. Next, you will see that as at 31st of December 2021, your carrying
Madam,
yes,
15 bagi 5, 3.
yes,
15 bagi 5, 3.
okay, is correct then. Okay. The first year. Oh, three, right? All right, three. Three, thank you. So 12 million. You will now compare with the fair value on the date 31st of December 21, which is your fair value 2. So this is fair value 1, right? Because there are two different fair value. So fair value 2 is 6.5 million. Where do you get 6.5 given in the question? This one? And if you compare now, you can see that carrying value exceed the fair value, and this is a revaluation deficit. And remember, this is second revaluation. So you need to treat this similar to MFRS 116. So the second revaluation. So the first revaluation was a surplus, second revaluation was a deficit, and that deficit is 5.5 million. Okay, what you need to do? Number one, to explain is first to explain about this amortization. You need to explain about this. And then you also need to explain that these amortization are being eliminated. Why? Because there is a revaluation here. Revaluation being done. So the elimination of amortization will also be done. So this revaluation surplus, you will debit your software. You will credit your ARR software with 5 million. 5 million. So on second revaluation for the deficit, what you need to understand is that you cannot simply go and expense off or go and debit to the revaluation deficit. The reason is because there is a previous surplus. So if there is a previous surplus, you will of course credit the software, because that this is a deficit. How much? 5.5. 5.5. You will credit that for sure. However, what you would debit, you cannot straight away debit to the revaluation deficit, because the deficit is 5.5 and you have a surplus before that of 5 million. So you have to go and reverse the previous surplus. So if you reverse before this, you credit, now you go reverse, you go and debit. ARR surplus 5 million. So the remaining deficit that cannot be covered by the previous surplus only then will be debited as a revaluation deficit in your software. So that will be your revaluation deficit. How much? 0.5 million. This one you do not need to prepare all this, but you need to understand before you can write the accounting treatment. And do not forget to eliminate this as well. You should be able to do this. Each amortization must be eliminated because the company revalued twice. So here will be eliminated, here will also be eliminated. Okay, let's look at the explanation of accounting treatment here. So if you do not do calculation, you will not be able to explain all this. Okay, the first paragraph here is explaining the initial recognition and initial measurement. So you need to write when is the date. The date here is 1st of January based on the question. The initial cost of the computer software, how much, and what is the accounting treatment. So it should be capitalized as intangible asset because it meets the definition and recognition criteria. Recognition criteria, you can also mention that the three criteria there. Yeah, the three criteria where it arises through provides future economic benefits, and it depends on the marks. So you can go and check the recognition criteria. Now you will talk about subsequent measurement. Okay, number one, you need to explain about the amortization that you just calculated. Remember, I told you that it should be amortized. So the amortization, where is it being charged? In the SOPL. Because it has what? It has a finite useful life. The carrying amount of 10 million is capitalized as intangible asset, the carrying amount, right? Okay, that is what happened. Next, you have to mention about the revaluation. Where is my cursor? All right. The revaluation now. So this the first revaluation. So you have to mention, since the company adopted revaluation model, the fair value will be compared with what? With the carrying value. So you will say the fair value as at 31st of December 2020 should be compared with the carrying amount of 10 million. Remember our calculation earlier, which result in a surplus on revaluation amounted to 5 million. and you need to go and explain what is the accounting treatment for that revaluation surplus. This is for 2020. Yeah, revaluation surplus is to be credited to ARR and disclosed in other comprehensive income. Then you need to explain about this calculation that you've done here, meaning that is about explaining what you have here. Yeah, what you have here. Yeah, what was in your calculation. So that's why you need to work out your calculation. So credited to the ARR, and the fair value of 15 million, which is on 31st of December 2020, will now be the new carrying amount. Then you need to mention this as well. Marks are given the accumulated amortization of how much? 2 million before the revaluation. Before revaluation will be eliminated. So it will be eliminated. So that was the first year. In the second year, you do not have to talk about initial measurement anymore. You just have to go straight away to subsequent measurement. Okay, subsequent measurement. This was also subsequent measurement. But this was subsequent measurement in the previous year. So the carrying value at the beginning of the year, how much? It was actually 15 million, which is the previous fair value. That should now be amortized over useful life of 5 years. Remember just now the amortization is 3 million that we calculated. So you need to explain what has to be done with that amortization. Expense off in the SOPL for 2021. And then you have another one. You have to also transfer revaluation surplus realized. Remember, before this, you have a surplus, 5 million. So if you were to find out what is the revaluation surplus realized, revaluation surplus realized, you will, first surplus is this one is the surplus on the first revaluation. Look at the one in red that I was showing you. So to find the revaluation surplus realized, this is from FAR 270. You learned this last semester. Revaluation surplus realized. You can take the surplus that you calculated divided by remaining useful life. So if you take the surplus, it was 5 million. Remaining useful life was 5 years, right? So you will have 1 million. This 1 million is what that you need to go and transfer from ARR to retained earning. As the revalued software is still in use. So you need to go and add this sentence there, right? So that was why? Because of this requirement. This requirement at the bottom here. This one, number 3. This requirement that needs you to write that extra sentence. If there are no requirement like that, you don't have to write the sentence that I put in red. So here you write because there was a policy that the company will transfer the excess amortization as the software is being used. So the excess amortization here is the amount that you consider as revaluation surplus realized. Then you mentioned about the carrying amount of 12 million that has to be compared with the revalued amount for the second revaluation, and that result in the deficit of 5.5 million. So later go and explain what is the accounting treatment for the deficit. So just now I show you earlier that the accounting treatment is that you go and debit ARR software. If you can still recall, 5 million. You go and debit the revaluation deficit. And this will be in SOPL, 0.5 million. And you will go and credit the software. But this one is not the answer. The answer is the explanation of what you have here. So you have to mention, since this is a subsequent revaluation or second revaluation, the balance of ARR, which is 5 million earlier, right? The revaluation surplus of 4 million. Is it 4 million, the balance of ARR? Yeah, 4 million. Why 4 million? Because first it was 5 million, but you have 1 million which is deducted due to revaluation surplus realized. This 5 million here is the revaluation surplus. Look at what I was doing here. So that's how you get 4 million. So the balance of ARR now becomes 4 million because previously you have transferred to ARR. Okay, just imagine this one. I erase this for a while. I want you to understand because or else you may not be able to do if you don't understand. So imagine this is your ARR in your statement of changes in equity. This is 2020 and this is 2021. 2020 balance brought down was zero. But 2020 you have revaluation surplus, right? Revaluation surplus was 5 million. In the same year, you have transfer. Transfer means transfer to the retained profit because of the revaluation surplus realized 1 million. So the balance is how much? 4 million, right? So 4 million here. 4 million is your balance carried down. So the following year, this 4 million will be here. So the revaluation deficit that you will have to go and offset is just 4 million. Yeah. So meaning that the one here, the one that I was calculating much earlier should be adjusted. This one. Just wait. Okay, this one here. I just erase this. Okay, it should be different. I put here 5.5 million, right? Here is 4 million and here is 1.5 million. So you need to look at the accounting policy of revaluation surplus. And here revaluation surplus was transferred um, to the retained earnings. So here now your balance become zero. Why? Because it was fully utilized. So you can see this is what I was doing in the statement of changes in equity. If this is the ARR for 2 years. Okay, done with that. This question is a little bit challenging as compared to the question that we have done before. Maybe you would realize that. Okay, so therefore now you can explain the accounting treatment, but before that you must first do the revaluation surplus realized, as I said just now. The balance of ARR amounting to 4 million should be reversed or debited. How much is being debited? 4 million. The remaining 1.5 million deficit should be expensed off in the SOPL because the previous surplus cannot fully reverse the deficit. So the total accumulated amortization of 3 million should be eliminated, and on 31st December 2021, the carrying amount of 6.5 million will be shown in the SOFP. So that was for the second revaluation. And take note again about this, the one here, the 5 million and 1 million, which gives you the 4 million there, right? Is there any question for this? This is similar to MFRS 116. It's just that here we are dealing with amortization. These were the same thing that I taught for FAR the 270 for topic PPE. Exactly the same, only that this is for amortization. Okay, do you have question, class? You don't have question, right? But be careful with the revaluation surplus realized, and be careful with the deficit when you have to first reverse the surplus. Now you are asked to discuss accounting treatment for the second situation. Before you can discuss the accounting treatment for the second one, you need to go and calculate some impairment. So I have already put some working here for you. So actually the original answer is just that you have the sentence at the bottom here. In the original answer, they don't show the workings. It was just the explanation. But I am making some kind of revision for the impairment. So first you have to see here that the cost of the license was 13 million. Check the question. And there, at first there was no amortization. Why no amortization? This is the one as at 31st of December, 31st December 2020. So there are no amortization here. And what I was doing is for up to 2020, this one, right? Okay, so therefore the carrying amount is 13 million. 13 million. So that 13 million will be compared with the recoverable amount. The recoverable amount is the higher of value in use and fair value less cost to sell. So fair value less cost to sell was 7945. 7945. You have the 8 million, the fair value of the license, and cost to dispose the license was cost to sell. So I will write here so that you can see better. So this one is the cost to sell, 8 million, and sorry, fair value is 8 million and cost to sell is 55 million. So you have 7945 million. So which one is higher? This one is higher. So you will compare with that. So you have a 5055. That was impairment loss. This is not the answer. This is just some working. So let's look at the answer. Okay. So you need to go and explain that answer here. So you have to go and explain about the impairment. So on 31st of December, there is an indicator of impairment. What was the indicator? The change in the or the reduction of useful life from indefinite useful life to finite useful life. Then you have to mention that the carrying amount of 13 million is compared with the recoverable amount of 7945. Show the workings. How do you get 7945? And here carrying amount is more than the recoverable amount, and therefore the difference of 5055 is recorded as impairment loss. And this is charged as an expense in the SOPR. So why it was charged as an expense? Because impairment loss here, even though the company adopt revaluation model for its subsequent measurement of intangible asset here, a subsequent measurement, revaluation model, there is no revaluation surplus relating to the license. So here what you do is you charge immediately the impairment loss to the profit or loss. So therefore the change from indefinite useful life to finite useful life will be accounted for under Mfrs 108. And you can add extra sentence that the carrying amount is restated. This is the sentence for impairment to the recoverable amount of how much? Recoverable amount 7945. Okay. And this is the one that will be shown in the soft P. Okay, class. That was for just one question that we go really detail. Yeah, and this is the end of this discussion for this particular topic. Yeah, which is this is the last question because this is the third week. We are supposed to move to our new topic. Okay, that's it. I have finished with that. I will share with you the recording.